way to predict earnings, or the way analysts do predict earnings, is to start with the top down. Basically, first what an analyst has to do is to figure out what industry the stock belongs to or the company belongs to, and what the average growth rates of top lines, revenue growth rates of that company has been over various cycles, and what the future is looking like for that particular industry and within that particular company. Once that revenue growth assumption is made, then the analyst tries to look at what the likely profit margin will be for that particular year or next couple of years, foreseeable couple of years. Because using that estimate of profit margin, it arrives at some kind of an estimate for the net profit and the earnings per share of the company. Now, all of this is actually going out on a limb because so many factors change. Competitive factors change within an industry. The industry growth rate itself is subject to various factors which may actually lead to an acceleration or deceleration of the estimates, and these revenue assumptions generally are revisited every quarter after every quarterly results announcements, and they are tweaked up or down. So this is the modality of arriving at some kind of an earnings projection on the basis of which the stock price target is set. However, the experience of the last 2 or 3 years, in fact the last 5 years, is that analysts often go very wrong in predicting the revenues and the future profits of companies. Therefore, I mean, if you look at the last 2 or 3 years, analysts start the year with 20-25% growth expectation in profits, and the year ends up with 5 to 7%. So that could be the extent of the degree of variation between expectations and reality. And every investor, while considering these earnings projections and price targets, should be cognizant of this risk.